So here is the back on the 15-minute time frame. So what happens once we clear this balanced price range here? Remember, we hit the bullish breaker line here. We have all these inefficiencies in here. What happens when we get above it? What can we do now? Well, we have a target up here. That's a draw on liquidity. And then we have now this old market structure high. So now we can take that range and draw a fib from that high up to this target. Now we have gradients. So now we're grading a future price swing that has not happened yet. As soon as this candlestick right here closes, now we run from high to target, and we run gradients. And now watch what happens. Around the 20, I have it backwards here, 75% or the lower 25% of the range between the draw on liquidity and the high that was broken. We don't think that the market's going to go down here. Why? Because this is a balanced price range. So we anticipate every instrument out there, every little gimmick, every little toy is going to say, oh, look, orders are getting eaten above market price. The footprint's showing that, look, it's bullish, just absolutely bullish. Of course it is. It's going higher. So we have relative equal lows, and they sweep that. Where does that occur? In the lower quadrant of the range from this high up to that draw on liquidity, which is the weekly mitigation block. That's what this level is up here. Then we have consolidation. Where does consolidation form, ICT? Oh, well, I said it in the core content lessons back in 2016, and I taught it to everybody that was my private one-on-one student back in 1996 at equilibrium, 50% level right here. That's where consolidation is forming. And then what happens? A stop hunt. Lower time frames, look in there, you'll see it. Rallies up. Another time here. And what happens here at the upper quadrant? From the draw on liquidity to this high, we're anticipating new price points that surge higher. That's what I'm showing you here. We rally up, then we take out the liquidity above that weekly mitigation block. Then we do what? We find some support at it. And then we consolidate going into Friday, New York session. That's where we're at now. This is a 15-minute time frame on Friday. And we're consolidating. Markets do not top like this, folks, especially ahead of news drivers. So a market report, we're expecting prices to go higher. We've consolidated. We're part of a bullish run. And we're expecting capitulation to come in. And that's what we're seeing here. Market rallies aggressively. What are we seeing here? See this gap right there? Extend that through. That's what you're seeing. That's an inversion fair value gap. Explosive run to the upside. Retracement. Failed to run higher. Back down into the sell side here for a T.G.I.F trade. Let's take a closer look. 5-minute chart on the NASDAQ. Here's that price run here. Then we have this buy side imbalance, sell side inefficiency. We'll get to that in a moment. And then we run up. We have a blow off move, and then we break down. Where's the fair value gap in here? There isn't one in here. Not on this side of the curve. The curve is here and then down. So you have to use the imbalance on the left side. That's going to be an inversion fair value gap. Extend that through all the price action. That's what you're seeing here. And then you have a small little fair value gap there that I didn't want to draw any annotations on because we have the inversion fair value gap. I can point it out like I'm doing here. Trades up into it here. And then we break. This area here is a breakaway gap. We want to see it stay open. So why should it become a breakaway gap? Because we have had a shift in market structure there. We have a buy side imbalance, sell side inefficiency. Relative equal lows, blow off move after the market has been going straight up all week as we were expecting it to. And then we have the inversion fair value gap. Is it respecting that? Yep. And then we break below the short-term low here, below this short-term low here. And where's liquidity at? Below here, sell side. But then we have this buy side imbalance, sell side inefficiency. So any rally from this candlestick open up into above this high, we want to see it stay open. What happens if it closes in? It's okay. I would still want to take a short up there if I was watching live. And the market breaks down. Doesn't get below the what? The bodies. So we still have this wick to contend with. So we retrace higher. Up close candles consecutively. That's a bearish order block. Breaks down through it. Extend the opening price over there. That's a change in state of delivery. Returns back into it here. And all of this consolidation is time distortion. It's not time for the market to do anything. It's not going to do it. It's already ran the low here, which is the lunch macro for New York. It's already did that, but we're not done. We have T.G.I.F. It's Friday, so thank God it's Friday. It's likely to do what? 20 to 30% of the weekly range in terms of a retracement from the high of the week. Where's the high of the week? Over here. When can we trust that's the high of the week? When we see this element here, and then we start seeing everything start breaking down. This high is intact. But what happens if it runs up and goes higher? Then you're wrong. How's that for logic? You're going to get it wrong sometimes. But you have to have rules and things to work with to grow in your understanding as a trader, and this is what I'm sharing with you. What time does time distortion stop? What did I teach you? Post New York lunch, we start seeing 2 o'clock to 4 o'clock. That's your PM session time. Then all of a sudden, what happens? The market delivers a run through low, lower low, fair value gap. Trades up into it. Consequent encroachment of the low on this wick. Boom. Sells off, hits the sell side liquidity, and trades to the 20% level of the weekly candlestick. So from the high to the low, measure that, and it retraces 20% of the weekly range in here. Right, and here's a 1 minute chart of that time of day. Here's the PM session. And I want you to see that inefficiency, that buy side and balance, sell side inefficiency. Let me take you back up so that way you know where I'm pointing your attention to. This range right here. Okay, we're looking at a 5 minute chart. We're going to drop down into a 1 minute chart and look at price action from here to here. Okay, that's what we're watching. But in this shaded area right here, I'm going to put the gradients in 25, 50, and 75. We're going to look at this return back into that shaded area here. Okay, so here's the lower quadrant, or 25% of the range that's shaded here. So here's the high, 75% of that range, 50% of that range, 25% of that range, and the low of it. So the market trades up into that. And we'll come back to that in a second. But let's go back up into here and look at some of the details. Right away, this should jump off at you. That's a breakaway gap. Why? Why should that be a breakaway gap? Because we are under time distortion. That means all of this back and forth price action is just marking time. That's the benefit of knowing how to use a time-based chart. I'm not getting fooled by candlesticks. I'm waiting for time. When does it start? Right there. 2 o'clock in the afternoon, New York local time. Because the market is driven by an algorithm. There's a time for everything. A beginning and an end. A pause, a consolidation, and distortion where everything you try to do will chop you up. So you wait. Wait for what? 2 o'clock. And then wait for displacement. What does that look like? Right here. Takes out that short-term low. Boom. But now we have what? We're late in the day. This shaded area here is the buy side and balance, sell side efficiency. We have moved away from the high, and we moved aggressively away from the 75%, upper 75% range of this shaded area. So I don't want to see this area come back into. I don't want to see it come back up and trade into that. But if it does, I would treat it as an institutional order flow entry drill. In other words, a partial entry and then sell off. Either way, it makes it a breakaway gap. So we don't want to see it trade back up above 50% or consequent encroachment of this shaded area here. And now we enter into another time of day. The 250 to 310 macro. My algorithm starts at 250 to 310 and we'll start spooling price running for the liquidity that has not been purged yet. What is that liquidity? The liquidity below the lows. The 7 a.m. New York session time, the 8:30 lows, the 9:30 to 11 lows, all of that is the draw on liquidity. And or, in this case, 20% of the weekly range. That would be anywhere in this area here. But we start to see this energetic price run, aggressive dropping lower. That's algorithmic. This, right here, just like I talked about earlier, when we ran up, you can use the fair value gap on the left side of the curve. And we're seeing that happen right there. If it would have been opening here, traded up right there, if I was wanting to trade short and I hadn't already been short, that would be an area where I would go short right there too. Then it breaks. This is a measuring gap. We don't want to see that filled in, just like we don't want to see that. What makes this a measuring gap? Well, between this high down to this low, we're expecting that run. And about halfway, we're expecting a gap to form. When it does, and it moves away from it, we are not expecting it to come back into that. That's a measuring gap. You have to know where the market's likely to draw to. If you don't have that skill set, you will not be consistent in your ability to define or classify a measuring gap. Breakaway gaps are just gaps when you want to see an energetic price run away from an area you anticipated prior to it running away. So you're expecting it to move lower? Great. When it finally does and it creates a gap like this, your first thought should be, okay, the first fair value gap after it starts to run, that should be a breakaway gap. We want to see that, especially if we've been in consolidation or experiencing time distortion. Time distortion is simply a matter of time between segments of time of the day where markets will start spooling. That's it. All right, folks. So I covered a lot of stuff here, and I will admit rather openly that this is not one of those easy go out there and I can do what ICT just taught me. Okay, but I'm showing you many things here. I'm showing you a amplified version of what we do by reading the tape. I've rung in macros. I've rung in time of day. I've rung in how we use breakaway gaps and measuring gaps and how we anticipate price action. And we don't look for ladders, depths of market, footprint, or any of those things because we're anticipating price performing a specific function. We understand order flow. What kind of order flow? Institutional order flow. Institutional order flow is going to be based on the things I'm showing you here. Price is the thing. That's the context. That's the prize that we seek. The better understanding of that. You can take the open, high, low, and close of every interval and beat it up, torture it with number crunching, and have it come out with all kinds of supposed insights, some kind of mathematically derived indicator. Or you can take the past and say, okay, this is how many contracts were bought or sold at this price, and therefore I believe this or that. Or you can look at a range above the marketplace price or below the marketplace price and determine, and there's a larger range of or number of orders above the marketplace than that of below it. And you might think that that is indicative of wanting to go higher. Not always. Think about it. What happens if you're in these types of situations here where you're right before the market is going to start going lower, but your depth of market, your ladder suggests that there's a lot of orders just above the market price. You might be convinced by looking at just that tool thinking that, okay, it should start going higher and eat into that number. No, that might be just a large pool of smart money's stop loss that isn't going to be tripped, that isn't going to be eroded or eaten into. And then you watch price run away and you're thinking to yourself, wow, look at that rip. Wow, look at that. Where'd that come from? What just happened? Somebody must be talking. All these things, folks, all these things come out of the mouths of people that just don't know how to do this yet. And I want them to learn. That's all. I want them to learn just like you. I want them to understand how they can capture these types of price runs and not hurt themselves in the process.